Let's talk about revenue retention rate, a number that tells you whether your business is growing or just leaking profit faster than a backhoe with a busted hydraulic line. This isn't about revenue. It's not even about profit. This is about what stays. How much money actually remains in the business after all the checks get written, the draws get taken, and the dust settles. Because growth doesn't come from revenue. Growth comes from what you keep. So what is the revenue retention rate? The revenue retention rate is equal to the net profit minus the owner of draws minus dividends divided by your revenue. Let me say that another way. You take your profit, subtract what you pull out of the business, whether that's your draw, your bonuses, truck payments through the company, or your creative write-offs that you then divide by your total revenue. Let's say your business made $2 million this year. You had $200,000 in profit. You pulled out $150,000. Between your draws, a new boat through the company, and paying taxes, that leaves you with $50,000 retained. Now divide that $50,000 by the $2 million you made. $50,000 divided by $2 million is 2.5%. That means you only kept 2.5% of what you made inside the business. That's your revenue retention rate. Now I want you to think about this. Can you grow a business on 2.5%? Can you buy new equipment, invest in people, invest in another city, or even make it through a bad quarter on just 2.5 cents for every dollar you brought in? Didn't think so. This is why so many contractors feel like they're running on fumes. They're pulling out money faster than the business can grow, and they don't even realize it. But Wade, I need to pay myself. Of course you do. I'm not saying you shouldn't get paid. You built the business. You took the risk. You show up every single day. But if you're trying to scale, if you're trying to break out of that feast or famine cycle, if you're tired of robbing Peter to pay Paul every time taxes or payroll hits, you have to leave some fuel in the tank. You want growth? You better stop siphoning all the gas for yourself. What's a good revenue retention rate? Here's a solid benchmark. 5 to 10% is decent. 10 to 20% is healthy. 20% plus? That's really strong, especially if you're self-funding your growth. Anything under 5% and you're playing a dangerous game. You might look profitable on paper, but the business has no reserves. And when cash gets tight, you're going to the bank, not the balance sheet. So how do we improve it? I'm glad you asked. Here's the blueprint for that. Number one, you need to tighten your overhead and protect your margin. Every dollar you don't waste increases what you can retain. Number two, be intentional with draws. Don't treat the business like your personal ATM. Build your lifestyle behind your business, not ahead of it. Number three, automate retention. Set up separate bank accounts. Hello, profit first. And sweep a fixed percentage of profit into it every month before you touch it. Number four, set a retention goal. Aim to keep 10% of your revenue in the business this year. Build up 3 months of operating expenses. Fund your own growth on your terms. So here's the final word. Let me shoot you straight. If all the money leaves when you do, you don't have a business. You got a job with overhead. The revenue retention rate tells you whether your business is actually building muscle or just pumping cash through a system that leaves you no better off year after year. Grow smarter, leave money in the business, and stop starving your future just to feed your present. Because the next time opportunity knocks, you'll either be ready for it or too broke to answer the door.